Hello and welcome to this week's Week Ahead for the week starting Monday, the 12th of January. Of course, we're coming hot off the heels of the latest jobs report out of the US. Yeah, another disappointment in terms of the payrolls figure. But certainly, we've got an interesting week ahead, certainly dominated by US inflation, but also some data coming out of the UK. So let's get into it. So, as I said, we have got a main focus really around US data, in particular that US CPI reading on Tuesday. And things have just been very muddled because of the US shutdown. It's messed up a lot of my charts, quite frankly. So, we're going to keep it pretty simple on this one. But notably, when we saw the previous reading without the monthlies, we just saw a sharp decline in terms of the headline inflation rate. So it was great news, but it did sort of stand out as being a bit different from what we're used to previously. And it appeared to be the case that many of the inflation metrics had just been put down as zero. So how much we can rely on these figures remains to be seen. But certainly we're at least moving back into a period where we see the monthlies coming out in any case. So CPI on Tuesday, we've got the PPI on Wednesday alongside retail sales. We've got the Chinese trade data coming out on Wednesday, and then on Thursday, a raft of UK data points and GDP from Germany. So, like I said, the US data is going to really dominate the week by and large. It comes off the back of a week that has seen a focus really on US jobs. We saw the ADP payrolls figure coming in below expectations. We saw the JOLTS job openings number coming in lower. The job cuts figure actually did decline. So that's one piece of good news. Then we saw a jobs report that had a little bit for everyone, really, because we saw a weaker than expected payrolls figure that came in at 50K. Markets had been expecting around 66K. But we also saw a sharp decline in terms of the unemployment rate down to 4.4%, and the U6, so the sort of total unemployment rate, which dropped down to 8.4%, which was previously at 8.7%. So we're seeing a little bit for everyone, really. And so this week ahead really does provide us at least with the basis, because you've got the two sides of the dual mandate for the Federal Reserve. You've got inflation, which of course is this week, and the jobs, which was the week just gone. So how are things shaping up in terms of inflation? Well, in terms of market expectations, there's a prediction that we're going to see a decline in terms of the headline number down to 2.6, and then the core figure remaining at 2.6. So those figures certainly aren't something to be too concerned about if you're in the mid twos, quite frankly. Certainly better than the situation we have in the UK at the moment in terms of the year-on-year metrics. And you can see that here. I mean, ultimately, I had to change exactly how I was displaying it here, because if you look at this 12-month inflation rate on both the headline and the core, it's better to use the black background, because you can see we've got a gap for the October number, which wasn't provided on the 12-month. But then we've got the November figure, which dropped down quite sharply, which is just a dot at the moment. And so, yeah, we saw a sharp decline in terms of inflation. Markets really questioned the underlying metrics within that. But certainly, if we do continue on the vein of seeing sort of 0.2s, 0.1s, maybe the odd 0.3s on a monthly basis, it does provide the basis for us to believe that the Federal Reserve can sort of go ahead with a relatively loose monetary policy as we move forward. Now, notably, the Federal Reserve, from a market perspective, are very likely to keep rates steady for the first meeting of 2026. That is in January. But for March, it's much of a coin toss, really. Markets pricing in a 52% chance of a pause. So the remaining 48% attributed to a rate cut in one form or another. So that's where we're likely to see movement if we see significant shifts in terms of this particular release. So keep an eye out for these pricing. This is on the CME website under the FedWatch tool. There's different sort of ways to look at it. This is the sort of probabilities section where you can sort of map out exactly where rates are expected to be and when. But certainly, whilst the sort of light blue box is in that 350 to 375 for the March meeting, the fact that it's only 52% highlights the fact that in actual fact it is a bit of a close call on that one. In terms of how to trade this event, you can see here in terms of the dollar index. From a monthly perspective, things are really interesting because we've come into this trendline support within a long-term uptrend, and for the time being respected it and started to regain a bit of ground. Now, I've spoken about this in the past and mentioned that, look, we've ultimately come into this first swing high, which is at sort of 100 mark or 100.2. That means that we've now created a higher low, sorry, a higher high, which means the subsequent pullback has the possibility of creating a higher low before the bulls come back into play. And that is what's happening at the moment, right? So you can see here the 61.8 as it stands, tagged perfectly. And now we're starting to push higher from here. So things starting to look a little bit more positive for the US dollar again on this sort of shorter time frame, which is the daily. You can see the sort of creation of lower highs in particular now over with the breakthrough that 98.749 coming into play. I would say that part of the weakening that we've been seeing is attributed to the perception that we're going to see the Federal Reserve cutting interest rates. And of course, we see a new Fed governor coming into play at the midway point, or well, May of 2026. Quite who it's going to be and what the outlook is for additional rate cuts on top of what's currently being priced, that could move the dial on this. But as things stand, it's starting to show a little bit of strength. And so keep an eye out on this one, because I wouldn't be surprised to see some bullish price action coming into the fold over the near term. Certainly from a CPI perspective, if we do see another significant move towards the downside, Trump and his crew are certainly calling for plenty of rate cuts from the Federal Reserve. And if they have their own person heading things up, and they have inflation continuing to move low, it does form the basis for a shift towards additional easing, which could put downward pressure on the US dollar over the near term. So keep an eye out for that. But at the moment, you're seeing this pullback, 61.8, rally up through resistance. That points towards a possibility of strength coming into that announcement. Next up, in terms of the areas to look out for, is the UK. Of course, the UK has got this sort of dump of data on Thursday in particular. The rest of the week, relatively quiet. The month-on-month GDP figure forecast to come in at minus 0.1 again. Not great, quite frankly. And on top of that, we've got sort of industrial production expected to decline, manufacturing production expected to decline. Year-on-year GDP expected to decline. So not great figures expected by markets. And you can see here in terms of the recent month-on-month GDP figures haven't been brilliant. You can see we're pretty much in contraction time and time again now. It's been quite a while now since we've actually seen a month of expansion for the UK GDP figures. So not ideal, points towards the possibility of maybe the Bank of England needed to do more, and that at least provides the basis for some optimism when it comes to the likes of the FTSE 100. In terms of pricing for the Bank of England, you can see here that markets don't expect much for the February meeting, but then things start to get a bit more interesting in March and April onwards, where people start to think that they're going to be easing more. But in terms of the sort of year ahead, markets are pricing 1 to 2 rate cuts. There is a possibility of additional easing in my mind, in particular if the data comes in weak. So keep an eye out for this. Of course, we would always sort of note that this could be a case of bad news is good news, i.e. weak GDP means that it's good news because the Bank of England's going to cut rates, or bad news is bad news. If bad news in GDP then starts to make people think, oh, domestically focused businesses are in trouble because they've got a poor environment to operate within, and therefore you sell them. Thankfully for the FTSE 100, it's not necessarily very domestically focused, very internationalized index, and therefore we could see the sort of benefits of it. So bad news is good news environment coming into play. In terms of the market to watch, really, you've got to be following the FTSE 100, following the recent rally through the 10,000 mark. Here's the FTSE 100, sort of from a long-term perspective. You can see it's been a really significant bull run. You can see since the lows that we saw in 2020, we've actually doubled all the way up to 10,000. So certainly during this period of sort of upheaval, thanks to Donald Trump, many people have been looking elsewhere for their sort of diversification needs that perhaps in the past they didn't necessarily feel like they needed to diversify too much. Certainly, I would say that the actions from Donald Trump within the defense sector, saying that he's going to stop defense companies from being able to uh, essentially enable buybacks and dividends. Again, that for me just provides the basis for people to think I need to diversify. Um, so keep an eye out for this. We've pulled back once again. It looks like it's sort of not even a 50% retracement, and the bulls are back in play. And certainly, I think it's likely that it's going to be a sort of bad news is good news environment. So if we see continued weakness, do people start to think we're going to see additional easing from the Bank of England? I think there's a strong chance that that does come to fruition. But certainly for the time being, the trend is very clearly a bullish one. And until we start to see a breakout through these key support levels, then I would expect to see more of the same for the FTSE 100. That's it for today. I hope this has been useful. Make sure to like and subscribe for more content like this. My name is Josh Mahony, Chief Market Analyst at Scope Markets. Have a great day and a great week ahead.